it actually could save what's about to happen.
When they can go to those passive investors and say, you now have liquidity, you're not stuck in this deal long term.
10 years turns into 2, 3, right?
A month. It could be whenever you need the money.
We're serving two types of investors, right?
If you come to us and say, I need the money right now.
You know, in 5.7 years, you've got $1 million in there if you put half.
That's the math I came to. We looked at it and we kept thinking, if we took that cash, what would we do with it? It's like give it back to them.
There's an opportunity here to be involved in something that will not only enhance but change and disrupt the real estate business into the future. The industry needs this. It's a little swashbuckling.
A little Wild West.
Yeah.
You realize that the longer you hold an asset into the future, the more it starts to diminish value.
So treat it like a private equity drawdown.
Correct. I hear them every day.
Yeah.
They call and say,
Anecdotal evidence.
anecdotal evidence. We're in the business of promoting sponsors, but just good sponsors.
Right.
For all this to work, though, there's got to be a secondary market, and that's what's been missing.
Oh, hello, welcome everybody. Thanks for being with us today. We are actually recording this in beautiful downtown Salt Lake City, or Murray, or close to it. So we are very pleased to be here. We normally do this, as you know, live on Zoom, but we've had the exciting opportunity to be in the studio with iShares and Michael and his company and his team. And so we've decided to record this. And as you guys know, regularly I say stupid stuff so we can edit that stuff out. And this is an advantage of doing it here. So I have to throw out a big high five to Adil, who introduced me to Michael, and I'm not going to tell you who Adil is because you'll call him. But thank you, Adil, for doing this. We have an exciting program for you here today, and because it's being recorded, you'll be able to share it with others that might be interested. And without getting hyperbolic, there's an opportunity here to be involved in something that will not only enhance but change and disrupt the real estate business into the future. So thanks for being with us, and thank everybody for being here with us today.
So, Arthur, first of all, thank you for joining us. I know
You're very welcome.
You're a busy guy, and this is big for us. So I want to give you first a little example of how we build our business model, because this, if you look at these three principles I'm going to show you here in a second, these are the core principles we build our business model on, and they will revolutionize the real estate industry and create a lot of wealth in the process. So let's take a look at these. So the first one is opportunistic rate of return. All that is simply, everybody knows that. You can charge whatever amount of money that you want on a return based on the need that it solves. The second one is the short cycle investing. Now this is one we've never seen in real estate before, because usually that's a 5 to 10 year period, and I guess short cycling is relative. But if you can get down to this 2 to 3 year range, you know, instead of the 5 to 10 years of non-liquidity, game changer. We'll talk about that today, I'm hoping. We get a chance to do that. Third is the ability to continually reinvest. Now, so if you're going to get short cycle investment, you're recapturing your gains, you're going to want to have a lot of deal flow. And our business model has a way to develop that deal flow and continually do it. So let me show you the power of this. I'm going to play a thought game with you. These guys have bankrupted me building this company, so I'm broke. But you know me, I'm good for the money. So I need $10 to buy lunch because I'm getting hungry. I got to feed the machine. I got two propositions for you. Arthur, give me 10 now and I'll give you $12 next month, or I'll give you $20 in a year. What do you want to do?
I like the $12.
All right, let's go with that. Let's see what happens here. So let's play this out a little bit. So the first option I gave you was I'll give you 20 at the end of 1 year. That's what your yield curve looks like. That's what your investment is. You got $10 invested all the way through. The 11th month, 12th month, you're at 20.
So I got like a balloon payment at the end.
Yeah. Now, I don't have to go any further. I can just say on the month one, you put the $10 investment in, it goes $12.
Yeah.
That's it. It's over.
Right.
But you're a smart guy. I know that because I've pursued this, being able to just be interviewed by you for a long time, you're going to say, you know, I wonder if there's a business around loaning $10 for 12. So if I can replicate that, in other words, if I can get that kind of deal flow, and I lend that $10 over and over again, and I know Anderson, he'll be back next month for another $10.
You're going to be hungry next month,
Man,
and
next
I'm going to
month,
have
and
$10 for you. Right.
And I'll give you the 12, and you're going to.
Yeah.
If I was your only customer, but there's got to be a bunch of other rubes just like me.
Yeah.
So let's say that becomes a business, so you continue to lend that out. Let's see how much better that looks. So that curve, it's just well, it's not a curve, it's just a flat plane,
Yeah.
but that gets you to $34 return.
Yeah.
So all of a sudden, you're a multiple, well, not multiple, but you're considerably better off.
Yeah.
But then, because you're really a smart guy, you look at it and say, if the market's for $10 investment, at one point I've got $20, so I can lend that out twice now per month. And somewhere in here I've got $30. Now I can loan out 3 investments per month. So if I started doing that and reinvesting that, so I'm recapturing my gain and reinvesting that gain, because now I'm getting into the short cycle reinvestment situation. What does that look like? Well, that curve looks like that.
Yeah.
Substantially better. Now you've gone from $34 to $51.
So to make it really simple for me, when I lent you 10, you gave me back 12. I'm going to lend you 12 now.
Now, if
The
you did
next
that,
time,
if
right?
you did that, I did it this way. I stepped it because remember, we're thinking about 2 to 3 years.
Right.
So if I change this out and say, forget about those being months, what if those were years? And what if that wasn't $10? What if that was 100,000? Say it's going to produce that same curve. In fact, if you go to our PPM, well, actually it's the pitch deck. That's the curve you're going to see. That's done in quarters because that's how we're going to operate this. So that reinvestment is done quarterly, and you start seeing that same high rate of growth.
So on some level, I might be smart since I wanted the $12 deal instead of the $20 deal, right?
Yeah, even though at the beginning it sounds, man, I'm doubling my money in a year. That sounds great.
Yeah.
And that's how real estate used to be sold. It sounds at the end, you're going to make a lot of money, but you'll be an old person when you get it.
All right. So we're going to talk about how we're going to do that.
Exactly.
But you can see being able to reinvest the way you're doing it this way, as you talked about at the outset here, this is disruptive. It's going to change the way things are done in the industry.
Yeah, I can totally see that.
The big question is, how are you going to do it? Yeah. And hopefully that's what we can get into today.
You're going to tell us today, right?
Yep.
Excellent. What often is helpful is framing out the problem, assuming that people some of which will watch this, don't understand what the problem is. So for years, there's been a secondary market for first right of refusal in the context of the operating agreements that exist, but not as a security. It's just offer it to the rest of the LPs or offer it back to the GP.
GP.
Right? So changing the context of the operating agreement allows you to treat this as a security, but is it really treated as a security from a SEC perspective?
It is. It's an unregistered security. Every one of these, David was just in here, did a 506C. It's an unregistered security, but it can be traded, you know? So the point being is that, and that's not even really the biggest problem for syndicators and for investors. The problem's obvious. For syndicators, they're saying, because I know this, you look at, there's a myriad of problems. So if you want to frame the problems, for a syndicator, 7 out of 10 people will say no because it's not liquid.
No to what?
To investing in real estate.
Yeah.
In general.
Right.
In general, they'll just say, yeah.
Long-term asset, illiquidity,
Yeah.
time to get paid back.
Everything about what you're telling me I love. I'm getting a better return. I'm getting tax advantaged investing.
I get cash flow.
I'm getting appreciation, and I'm getting it leveraged.
Yeah.
All of that totally makes sense. Vastly superior investment out there.
Yeah.
And then you say, great, I'll need your money for 5 to 10 years.
Yeah.
And you go, yeah, I'll
Yeah.
pass.
It's a pushback. Yeah.
That's a lot of people that would otherwise invest, except for that.
Yeah.
And sponsors saying that basically have cut out a whole bunch of people then. And the reason why they did that is because there really was not a simple way to trade those things. That was the only reason why they did it. And they were the ones that put those restrictions in their operating agreements. My hope is they'll recognize the opportunity in it. I think the investors definitely will.
Yeah.
Their investors will see it and they'll want to gravitate towards this. And I think it's going to push a lot of sponsors that way. And I think when sponsors realize how many more investors they would have, they will want to do it as well.
But what I'm saying is that, yeah, that's the crux of it. You want to frame the problem. So that's a couple of problems that alleviates. But also I know as a sponsor, when we're talking to David about it and everybody's come in here, they don't want to be in the business of trading their own security. They're real estate guys. They're saying, God, if I'm raising money, it's not to take you out,
Yeah, right.
Arthur.
Yeah.
I'm on to my next deal.
Yeah.
You know, don't ask me to go backfill
Yeah, it's
you.
your problem, right?
Yeah. You know, you committed 5 to 10 years. You know, one of the things that we realized is that clearly what's going to happen is the cost of equity is going to go down for real estate. And so that's going to be a game changer too. There's so many places where this is so disruptive.
And because of the cost of equity is going to go down and the risk that investors have in investing in it, it's also going to take down the need for the higher returns that you typically need to have in order to attract those
To cover the
investors.
promote.
Yeah.
Yeah.
And so what will happen in today's day environment, it fits really well. Cap rates decompressing and lending requirements such as they are, it's making it difficult for sponsors to be able to find a deal that works for them. Well, the sponsor that doesn't have to have as high a return requirement can then pick up a whole bunch of deals that other sponsors can't make work for them.
So being the vulture predator that I am, wouldn't there also be an anticipation, if it's true, of the crash in the commercial real estate business that may be coming or otherwise, that there'll be an opportunity to be, I'm using harsh words on purpose, a predator buyer at deep discounts, even though the secondary market isn't robust? Will you be able to approach some of these LP interests post adjusting the sponsor's operating agreement and capture some of that, fire sale stuff?
Yes.
That's our hope. And for those that don't have the fire sale, that they want to keep it going, but they've got to refinance, they've got to do, and they're doing all these huge cash calls.
So yeah, cash call right now, I've talked to a number of investors. We were just talking to one. The default rate on a failed cash call from an investor right now is up to 18%. So there's a big delta. And besides that, and eventually in the future, right now you can't solve debt with more debt right now because debt's too expensive. So the only way to bridge that is equity. Now, if you want to play the game of vulture funding, like you were just talking about, you can say, which I used to do all the time. I would wait and say, yeah, I'm not interested in buying it. By the way, who's your banker? Who's your lender?
I was going to say that the bankers are going to, my editorial, so forgive me, what usually happens, right? Someone buys a $100 million building, it goes to 120 in 3 years, they recapitalize, take money off the table, go do another deal, right? And then the cycle comes, the value of the building goes from 100 to 80, everybody gets smoked, the bank takes it back, and then someone buys it for 60.
Exactly right. So I played that for a long time. And right now there is private capital that's amassing to do that. The only way to beat that process, because you've got to wash it all the way through the foreclosure process, the only way to do it is make an equity injection in it before it gets to the bank. You still get the same basic discount, but essentially you're taking it off the table from a foreclosure, preserving the equity that's existing in the investment and just diluting it to the return you want. You'll get the same.
It's a crush down round.
Yeah, it is exactly what it is.
Yeah.
So
For all this to work, though, there's got to be a secondary market, and that's what's been missing. And what Pre-iShare is doing is creating that secondary market that then allows us then to do the things we're talking about, where then you're basically marrying the needs of the sponsor with the needs of their investors by doing that, because it gives them that option then to be able to liquidate their investment when they need to. And it's something that just doesn't exist in the market now. And our secondary market will help that take place.
And the financing or the capital for the secondary market will come from those investors that wouldn't otherwise invest because of the 5 to 10 year time frame.
Well, we're not actually looking for investors to themselves to bring in the money, to put in that way. Where we're going to get the deals from is from the investors, the people who have already invested. And that's what creates the short cycle investing we're doing. Say some sponsor's got a deal out there and they've got a major cash call, or you've got a few people in the deal that got some kind of emergency need that comes up. They're going to take that and put it out on our listing hub. That's the secondary market. And of course, when they put that there, that also gives us, with our fund, an opportunity to have a first look at those as they come in. And the fund might buy some of those. And that's what's going to give us, on top of the preferred equity, that'll give us the inflation hedge that we need in the fund to give us the upside on the returns, to get us the higher returns. And buying those hopefully at a pretty good discount.
So in the context of this discussion, the ask for the Family Office Insights community is it investment in the company and investment in the fund?
It's an investment
both?
in the fund. We're not including, the listing hub in and of itself is not a profit center for us. It's just a means to an end.
Here's the listing hub, or at least a mock-up of the beta version. So that's,
I can see that.
there we go. There we go. And then they can connect with the sponsor or the seller. So we're serving two types of investors, right? We have the investor that will list on the listing hub and may even purchase on the listing hub, and then we also have investors in our fund. We're specifically interested in investors in our fund.
Got it.
So the listing hub, if you don't really need immediate liquidity, the listing hub would wait. We'll make you an offer, Arthur, and say, and we'll close within 48 hours with you, because we're going to have a chain of title of how that took title into the SPE with the original sponsor. We'll know everything we need to know in order to close, because they were already in our ecosystem all the way through. So if you come to us and say, I need the money right now, then our advantage is that it gets to that, how bad is the need? So we can make that happen for you. And we can have the money to you in the next couple of days.
Assurance of close at a discount.
Yeah, but
Right.
we'll make a discount on that. And if you say, no, I don't like that, go ahead and put it on the listing hub. But the idea is that we want to catch the opportunities where, especially with our approved sponsors, where the individual is trying to, that they need that money right now. And there is a lot of people, I've known that for years. When Kent and I were syndicating together, we did, during my career, I did about $7.5 billion. And I think you did probably half of that at the same time with us. Yeah, somewhere right around there. And it was a pretty continual flow of just life-changing events. I got a guy called me one time and he said, hey, I invested in this so I'd have college funds for my kids. And my kid just got into an Ivy League school and it's $40,000 a quarter tuition. Who knew? But I need my money. And it's like, I can't say no to that, because the guy told me when he gave me the money, it's for my kids' college education.
Have you found that, so for years, large hedge funds would go to Bank of America or JP Morgan and get an advance on their carry, the 20 of the 2 and 20. And they would do that just because they wanted to grab some cash and buy something else or invest. Were there banks financing these LP interests, or are they now?
No, they would do it on the GP level. They would do it because you could get a portfolio loan, but classically, none of us ever did portfolio loans unless we were going to roll it into a private REIT.
A REIT, yeah.
Something like that. So you would consolidate all the investments together, get a portfolio loan, and then, that's what happened to the company I sold. They just rolled it into a private REIT. But traditionally, especially in the last few years, just because of the way the credit markets were working, which were pretty haphazard, mostly because of trying to spur the economy on after COVID, but money was free. And that's what we were just talking about this in the previous interview, that apartments in Phoenix for a B-class apartment started selling for more than new construction.
Replacement costs, yeah.
Replacement cost. And it was just like, that was all capital driven. And so why would you worry about consolidating? Because then you can't isolate the assets, pull them back out, because you got to, I don't know if you've ever done that before, but if you go back to a lender and say, I want to pull this asset out, and they say, yeah, we'll do that for 120% of its loan value, you know? So, because they don't know if you're pulling out the best asset or not. Yeah. So anyway, the best way to have done that is just to refinance, and everybody was refinancing in the last
Yeah,
2 or 3 years.
recapitalization, take money off the table. You
Oh,
own,
yeah.
own the same amount of the building, you go do the next thing.
Now, there's another element that I wanted to go through that makes this short cycle investing work even better than traditional ways of investing in terms of what's going to be able to go into the fund. I'll start off with buying just a piece of real estate that you're going to syndicate. When you're buying something like that, a lot of that may be based on the returns of the prior owner of the property. And then you have to look and see as a sponsor, okay, how are we going to manage that property? And then you build your performance based on that. The difference with this, when you go out and sell a syndicated interest on an existing deal, there's 2 huge opportunities that come with that. You're not buying that with the intent of keeping it the amount of time that the sponsor originally had it. If they said 5 years, we might be looking at 2 years left on it, or 3. And the other thing you're getting with that is you're getting a demonstrated track record rather than buying pro forma. You can then say, okay, here's the historical record on that property and how it's done. You know, so you've got the original projections, yes.
So it's already perfected an interest in the NOIs.
Yes, and you've got a shorter term horizon, so your risk is lower and your return is higher because of the shorter time.
And demonstrated that those NOIs are there.
So you're buying an established cash flow. And then the other aspect of that too, which you never really talk about in real estate in these terms, like we were talking about in that illustration we just went through, if you know the time value of money, you realize that the longer you hold an asset into the future, the more it starts to diminish value.
Drag.
Yeah, it's just a drag. And real estate was built that way, you know. And so with this being able to do short cycle investment, actually we were looking at it. We think this would be a real plus for investors because they'll get the same feature we will through the listing hub or selling to us. So you could have a situation where maybe the internal rate of return on investment was going to be over the life cycle of the investment was over that 5 to 10 years was going to be maybe 25%.
They picked the 3 prime years, the 2 prime years of,
Yeah.
right? Because the ramp up time to get there, demonstrate that the prior return on investment was there. Then they take the 2 prime years and then, okay,
Yeah.
so who are you selling it to?
So if you break that time frame down, and I've done it held it long enough to get past the capital gains, so I'm tax favored there. Probably was sheltered the whole time I had it, but it also allows our pool to get a 28% internal rate of return off of the acquisition that we can carry forward into that investment cycle ourselves for 2.5 years. And if we decide we've held it too long, we can dump it back on the listing hub.
If I didn't understand that, there's obviously people who are much smarter than me. So how does the 24 for my 2 years, then I go and put it on the marketplace. Is the house buying it?
Yes. So we would we've done that. We show that you can look at the video on it where we've actually done the math and demonstrated it. And Christian, you did that video for us, and it was, we demonstrated that for what was 3 years hold cycle?
Yeah, that was over, I think it was a 4-year hold cycle.
4-year hold cycle. That the investor that was selling got a 24%, and we were getting a 32% by finishing up the hold cycle. Because all of the gain, like you said, as you lose value over time, all of that gain is that initial holding period. And the reason we don't get better internal rates of return in an asset that's leveraged and has appreciation as well as cash flow is because we hold it so long.
Yeah.
Now, there's some other elements that come into this as well. So we've got in here the fact that you're buying it at a pretty good discount, which gives you quite a bit of upside. You got a short time investment horizon that you're going to have for it. You got the demonstrated cash flow of what you bought coming into it instead of pro forma. For the fund, because you're buying a whole bunch of these, you're getting diversification across different asset classes and geographic
Just not
locations.
stuck with one building.
Yes. So you're reducing your risk across all of that.
And sponsors.
Yes.
3 forms of diversification.
And then a fifth thing that we feel that the fund benefits a great deal from is the fact that you've got all of this activity taking place over a very short time frame. So you're going to have constant liquidity in the fund for either future acquisitions or if people want to pull out some cash. It's not going to be like a traditional REIT or other things where you don't have that option. There's going to be plenty of opportunity within the fund for that to take place.
So do you think that the tax deferment, and we're not giving legal advice, but I'm thinking about the K1s and I'm thinking about the rolling over of the increased value from year 1 to year 2 to maybe year 3. So aside from the cash on cash returns, can the equity increase roll over each year without a taxable event?
It depends. And I'm not qualified to give you that
Yeah.
answer, but if you go to if you go to our offering agreements, we'll give you the caveats to that.
Yeah.
I don't see that this will ever qualify for a 1031 because it's again a security interest.
Yeah, and it's not same like exchange. It's
Yeah,
like
no.
diversified enough
Right.
to not, I think, right?
But there is provisions that you can do that with security interests. But we'll have to operate the fund, and it depends also on the investor and how they're structured.
Yeah.
So that's beyond our scope probably to discuss here, but
Yeah.
there is, it will not be at the fund level, but it will be at the investor, how they treat it tax-wise.
What I'm thinking is either in a traditional IRA or a Roth, where all that, Roth, it's never, as long as you paid the tax at the initial.
Tremendous for a Roth.
Yeah. So
Yeah.
can we talk about the profile of what you think the investor in the fund looks like?
One of the things we realized when we put this fund together, because of its unique characteristics, we originally thought, well, okay, let's do a $100 million fund, and that's probably short of what the demand is by a long ways. Then we were looking at this continual reinvestment rate, and we realized, first guy that committed to it was me, and I said, I'll put $1 million in. So I went and analyzed it for myself. And I thought, well, first thing that Kent's going to do, I know him, I don't want $1 million from you today because it's a drag on return, right? I got to go arbitrage that. I don't do that. Yeah. So I'll call you, I'll call you when I've got opportunity, maybe do it on a quarterly basis, and I'll call you and tell you when we got stuff coming up. So, and then advance me the funds in. If you want to put up a
Just
line of
draw
credit.
down, whatever.
Yeah, put up a line of credit or whatever you want to do, but I'm not going to hold cash on the books. So then I realized, well, I'm not investing all of it right up front. And then I thought, how fast does this ramp up? And what's the chances that I would get that full $1 million ever invested into this? And I realized when I did the math on it, I realized depending on a number of factors, deal flow, how fast this ramps up and everything else, I might not only get about 50, 60% of that ever invested. And then from then on out, if I just
Keep
left,
on rolling it. Yeah.
if I just left it. And so we designed, our CRM is going to be, for the fund is based on that fact, saying, well, let's build in liquidity to it because we have constant liquidity. So I could look at it and say, I could leave principal in investment, I could leave the gain in the investment, and I can also leave the income in the investment. Or I could take any of the 3 out at any time I want. Take the principal out, it's not taxable.
Yeah, it wouldn't take you more let me just use the 30% number. In 5.7 years, you've got $1 million in there if you put half.
That's the math I came to.
Yeah.
And it was like, I looked at it and I thought, that can't be. I said to Ken, I said, is that really where it is? So we originally thought this was only going to be for qualified investors. We didn't think we'd bring it to accredited investors because that's been our bread and butter for years. But come find out, accredited investor, this would fit very well. A Roth, this would fit very well for, so because all of that would grow under tax deferral.
We'll have larger minimums. It's going to make it a little difficult for a number of Roth investors. So,
Which, what do you
well, our
see?
attorney started out pretty high. We brought them down just a bit, but where did we end up? About 250. So
No, 500,000, I think, but 500,000, but it's a 10% commitment. So, because we've already got that much demand right now.
I am wrong very, very often, but I don't see that as a problem.
No, it's not.
Yeah.
But the problem is that we didn't have the big book of how to do this.
Right.
Just our experience.
Yeah.
So we looked at it and we kept thinking, if we took that cash, what would we do with it? It's like give it back to them, And then we started thinking about, okay, well, how do we ramp this up? And then so what we've been at this for 14 months.
You've been at it longer. I've been at it for 14 months.
So we wanted to thoroughly test all of this because we really did not know. And I don't know that we fully know what's going to happen when we do this, but we have a pretty good sense. We know what the demand is because we've tested that. We know what the response from sponsors are. We know what the response is from investors. So we feel pretty comfortable starting at that 10% investment level of the total fund within the first 2 quarters, that will give us an appropriate starting point. And we're not going to be overwhelmed on cash demand or overwhelmed on product demand. And then that scenario that you just said, you're looking at about 3 years, you're funded out.
Yeah. So treat it like a private equity drawdown.
Correct.
And what do you think the I'm going to call it capacity, but the deal flow looks like? Meaning, will you be able to have enough business to fill the capital that you might raise?
Preliminary indications are very, very, especially today.
we've acquired a pretty long list of about 33,000.
No, we're over 40. Yeah, we have over 40,000 accredited investors on our current database list.
And we work that list. How often? What do you do to?
We have different sets of, I oversee kind of marketing and operations. And so we're emailing our investor database. We have a sponsor list. We have some other lists too. And we're emailing them weekly, some of them bi-monthly, some of them monthly, depending on kind of where they fit in that. And just on updates of where we are and what we're doing and different updates with the company. I mean, from launching the studio to launching the fund to the beta version of the listing hub launching to all sorts of other things that we've been building out that are finally coming to fruition.
So that was my question was, one second, Christian, the subject matter to accumulate those investors has been, you just mentioned a few, but what is causing them to consider being on that list?
Whether or not they want to sell their investment, is that you're asking?
No, I'm just saying what has caused them to want to be part of your community?
Oh, they were part of the community before pre-iShare.
Got it.
This was a list that we've been working.
Got it.
All
got
of
it,
us
got
that have
it.
been in the syndication business know these people.
All right. Yeah.
And so it might not be the most scientific way to do market analysis of the demand of that group, other than I hear them every day.
Yeah.
They call and say
Anecdotal evidence. is
anecdotal
almost-
evidence. Yeah, and it's been that way forever. But you get into these kind of market conditions, and we were just talking to one of our investors, and she said, how long until you have the pre-iShare fund ready? And I said, what's going on, Chelsea? And she said, I with another sponsor, which is, we'll be working with all these sponsors, but it was another sponsor. And she says, I just got a cash call for 1/3 of my original investment. And if I don't make it, it's got an 18% premium on it. And she goes, can you buy it? Yeah. And so
Yeah.
they're all in that boat right now.
Gotcha.
And if that's not going to put them in there, then just depressed economic times, tech investors right now who are now probably flipping burgers, with that MIT tech degree, are thinking, I'd like to get out of those real estate investments. So if we were launched today,
Yeah, you'd fill the order.
yeah.
And where this ties in, as far as demand is concerned, with us having access to all of these sponsors and continually reaching out to them, is we have the liquidity service, but we also offer pref equity in two different forms. And so that's another way that we're putting this capital to work within the fund, so that we're building those relationships with those sponsors. And in so doing, they're changing their offering agreements to create the liquidity within there. And they're the ones that want us to buy those fractional shares, so we take the problem child out of their investment and they can focus on their next deal.
Raising more money.
Yeah. So there's one way, two ways. So if you're a sponsor that's in trouble, and a lot of them are right now, I just looked at a list of that's consolidated by the people that loan on commercial real estate, just for syndication purposes. And there's over 4,000 properties that are in the watch list range right now. That sounds bad. 2008, that would have been a drop in the bucket.
Yeah.
So, which I went through that, and there was a lot of transference of wealth during that period of time. But we give that sponsor two options. Do you want to give a cash call? In which case, anybody that doesn't want to make the cash call, send them to us. We'll buy their interest. If you don't want to do a cash call, which most sponsors, if they reason that through, saying, "Yeah, I'd rather not do that because that sort of ends the relationship when you do that kind of stuff." My other option is to take pref equity. Same net result.
Yeah.
The only difference is we can also then start stepping into funding the GP interest.
Yeah.
So it's a way of heading off foreclosure by injecting capital into the ownership to the point where we get that benefit.
So is there a default type interest in financing the GP interest? I'm just wondering how harsh the coupon would be. What's the uncle rate for that?
It depends on, again, it depends on how bad the situation is. Some of these stuff, Neil Bawa was in here recording about 2 weeks ago, and he said some of the stuff no one could save. The Lord himself couldn't save it. And the reason being is because credit got too loose. And he said, so, if you were buying real estate at a 2.5%, 3% cap rate, 50% over replacement cost, and you were doing that with 3% money, so you had no leverage or maybe even inverted leverage, you're not going to save these today. They're just going to have to go wash through the system.
But on the other side of that, there are some of those that are very close to working, but because of the increased interest rates, they need that injection of capital to go from a non-performing asset to becoming a performing asset immediately.
Yeah, the ones that are going to be salvaged are the ones that got paid a little bit higher interest rate, but got fixed rate for 10. So if you just took that list of 4,000 properties on the watch list to say, what out of that group had fixed rate debt on it? The problem we had is we had a whole bunch of people that were new syndicators got in the market and said, oh, I want variable rate. I get a much better return. It's like, that's a two-edged sword.
Yeah.
Thought
they were going to live another day.
Yeah. And it cuts both ways, and it's cutting back the other way right now. Those are not fixable. But the ones that have got 10-year fixed, and just right now they're just struggling a little bit because the markets are a little bit off. Those are the ones that are salvageable.
Yeah.
I think.
And probably the ones that are not leveraged very high. If
Yeah,
they're not
not
leveraged
leveraged
as
very
high,
high.
they're still in that same position.
There's
They
some
can
room.
take the higher cost debt and still continue forward. They might not give the same returns that they were originally projecting, but they can keep the deal going.
Keep the
And when I say 10-year fixed, that they're probably 5-6 years into that. So you're going to probably survive that
4 or 5 more years. Yeah.
Yeah, and by then you should be out of the economic. That's about the end of the economic cycle that we're in right now. Is 2 to 3 years out.
So what needs to happen? The next 3 things to have the marketplace active, be able to take in investor money, that sort of thing.
So we've funded all of that. We've built all that infrastructure. That's all done. And so we're comfortable with the market intelligence that we've gleaned over the last 14, 15, 16 months, whatever it's been. The infrastructure is in place. We're just finishing up on the listing hub right now. Although that I think will never be finished. The more I talk to the IT guys, it's just like, oh, and one more thing. And it's like, and one more thing.
Sounds like a change order to me.
Yeah, it is. Yeah.
Well, and there's always going to be new things you're going to have
course,
to add to it
yeah.
because I mean, if you think about it, all the different types of real estate that are coming in, you have to blend all that and put it out on one database and have all the different types of information that would come with each different asset class. That's an awful lot of work to put all that together. And we're going to be developing with that an automated way then to value each one of those assets as they're coming in. And that'll make it a little easier for the fund then to quickly get through those that they may be interested in buying.
Yeah, we went from analog processing for those to, in a blink of an eye, it's going to be nested on AI, and you're just going to give us the algorithms, and we'll take it from there.
Well, and I think we really believe that by the time people watch this and go through the offering memorandums, we'll be ready for funds. We are at that point, and we've gone through all of the hard work.
Yeah, that's why we reached out to you, is because we think, all right, we're ready. And we've had a lot of interest. Few people we've talked to a few billionaires who said, we'll take the whole fund. That's problematic. That is a problem. And it's so, because we've been in this business for a long time, and we still are convinced that this is going to have a lot of challenges. Somebody that's not in our position can't be making those decisions.
Yeah.
So, and it's too important for the industry. Even if it was one investor and it was just that one investor that was losing their money, through bad decisions, this is too important to the industry not to get it right. So that to me is why we've looked at those and we just said, no, can't do that. So it's just we can't let anybody have, I think we said
Yes.
20% or something like that.
Yeah, totally agree. Just because that type of investor, and I don't mean to be disparaging, is not going to allow you to get your sea legs. He's going to be riding you the entire time for an exit.
Yeah.
Yeah, and something else that we have been great at doing at Pre-iShare is we've literally just been adapting our business model, adapting different client relations that we have, or client services, whether it's the approved sponsor group that we've had, whether it's the listing hub. Each of these we're adapting as we have those conversations, as we get feedback. Just with our approved sponsor group, I mean, that took us months to build out, months of workflows and charts and all the things, and we're still adapting it to best meet our sponsors' needs and continue to build that relationship. Same thing with the investor, same thing on the listing hub side of things. What we'll do is we'll continue building that out based off of the feedback that we're getting and how we can best serve the marketplace.
Adjustment.
And to make that work, let's talk just a little bit about that. What we're also trying to do with that, Kalani just mentioned a little bit about our approved sponsors. Maybe we ought to spend just a minute talking about that, but what we're doing with that to try to bring investors in is we're doing background checks on sponsors. Now, traditionally, when somebody invests in a syndicated deal with a sponsor, many times they just heard about through word of mouth through somebody else. Or sometimes they went out online and went to a site that is got sponsors advertising their stuff through equity funding place. But none of the information on those sponsors is vetted. Rarely do you see much vetting information or anything like that. Well, Pre-iShare has put together criteria, based on our experience, what we feel the typical investor wants when they're investing with a sponsor. They want to know, do they have any criminal history, or what's their track record? How many years experience of doing? Are they investor friendly in terms of the frequency of their distributions?
Do they get a K1 out?
Get the K1s done, yeah, things like that. Yeah. Those are important things that they wouldn't have by looking at a listing that's out there on some equity funding place. They wouldn't have that information. All they have is word of mouth, usually, or just a little bit that's out there on whatever place they go to get that. Well, we have developed the criteria, then we score sponsors based on that. So sponsors come to us, we do the background check on them, we get them qualified, we put our qualification on that sponsor that says, okay, here they're meeting this minimum criteria. That means an awful lot to the investor. And so I think it's going to create an awful lot of interest in the investors then to come to our place to say, okay, tell me about the different sponsors you've got out there on our site that are approved sponsors. Is a deal that I'm looking at, for example, this sponsor here, are they one of your approved sponsors? It's going to create a standard for the industry that they have, and it'll
Makes
make
a
it.
lot of sense.
So that's something that's being done from the investor point of view, so they can see what the sponsors are that they be looking at being interested in. The other part we're doing is from the sponsor side, and maybe Christian, you could talk a little bit about that and what we're doing to help attract the sponsors.
Well, part of this ties into another one of our key principles, which is transparency. We want to create more transparency in the marketplace. And so this studio right here is actually created to bring sponsors in and interview them and help them in their raise. And so if we go do a pref equity situation, we want to help them backfill out our investment as quickly as possible.
Skin in the game, yeah.
And so that keeps our short cycle investing going, and it keeps them moving forward in their own transactions. And so the more we connect with those sponsors, they're the ones that are connected to all of those passive investors. And so they're going to come and they're going to be looking for the sponsors, and they're also going to have the liquidity factor for themselves.
Companies like IMS, Juniper Square,
Syndication Pro.
Syndication Pro, we're developing relationships with those people then, who can then put that as an option out on their
On the
system.
dashboard,
Vendor, yeah.
right on the dashboard. Just say that asset and go, yeah, I think I want to let that one go.
And then that becomes another IT thing that we have to deal with, where
Yeah.
somebody wants to liquidate their investment, they would actually go into their dashboard with whatever their provider is, say, I'm interested in seeing what I can get from my deal.
And the goal is, if they're a approved sponsor, then on these different websites, the investor can just say, sell now. And it just shifts right over onto the listing hub.
We come back in a few minutes with an offer price, and they accept it. We close it in a couple of days.
Yeah, our listing hub will also indicate if any of the sponsors are listed on there, if they're an approved sponsor, if they've gone through our vetting process. And Arthur, just to point out real quick, whether to you or to those that are watching right now, I mean, we're committed to this. We want to be able to help sponsors, partner with them, help them raise their own standards within the company, help them communicate better and share information and get K1s out in time and show them what it looks like to be a good sponsor. But then also on the investor side of things, well, what's their biggest pain point? Liquidity. Well, great. Now we have an option for that, which is a listing hub. It's a listing portal. We're not playing a broker dealer role in that. And that's really to help investors. So we're here. We want to see both sides win here. And we really want to raise the industry as a whole.
What you said earlier that's consistent with that is the industry needs this. It's a little swashbuckling at
It
times,
is.
right?
A little Wild West.
Yeah.
Yeah. We're in the business of promoting sponsors, but just good sponsors.
Right.
And we knew that right off. But to get back to your original question, how do you know this is going to grow? Because sponsors co-promote. So if you take every sponsor, you say each sponsor may have in the neighborhood of 2,000 to 3,000 investors that they're working with on that. They want to take all of our material that's professionally produced. Client group packages that, builds them a branding package, because they're not good at it. They're real estate people, but they're not good at that.
Right.
And say, let's build your image and let's promote that. So if you take that and you say, if we add initial 50 sponsors, multiply that by 2,000 on average of investors, and now contractually we have a right to work with those people to buy their interest, that compounds up very quickly.
Yeah, for sure.
So it becomes very disruptive in a very short order. And the buy-in from sponsors, I have yet to have sponsors that have gone through and listened to what we had to say and say, yeah, sign me up.
So that was one of my questions, is the pushback on asking them to retrofit their operating agreement to recognize the secondary market, let's call it that, pre-iShare market as a security.
Yeah. And they all know it. We all know that. No one's pushing back on that.
Yeah.
It's one of those things that we were never very comfortable with trying to deal with.
Yeah.
So generally the response is, and if you go back and if you look at the interviews we've done, because we wanted to establish that fact. So we've probably got about 5 or 6 interviews, I think, right now that are on the pre-iShare YouTube site, where we've had sponsors come in here and say, more or less, it's about time.
Yeah.
Somebody needed to do this. I was not going to do it. I would never do that. Somebody needed to do this.
And that's the pushback. The only pushback we really get is I don't want to have to facilitate backfilling previous deals. So if you guys are going to take care of that, then
Yep.
that's great.
That's what they're saying. It's about time somebody did this.
Yeah. Yeah. And it may be a little more work on their part to amend things, but guess what they have? They have more added value for their investors.
And they don't have to deal with it
But in the
because now
future,
they've been just saying no, right?
yeah, in the future, it won't be more work. That will be the standard operating agreement. We all work on pretty much a standard agreement anyway. All the attorneys charge like they wrote it fresh, and to my attorney friends out there, they don't deny that fact, but that will be a standard clause. It'll be a standard clause. If not us, it will be a standard clause that you can go to a secondary market.
And the sponsors are going to see the benefit of it's going to be easier for them to raise money, as we started this whole conversation with, when they can go to those passive investors and say, you now have liquidity. You're not stuck in this deal long term.
10 years turns into 2, 3,
Yeah.
right?
A month.
All right, a month.
It could be whenever you need the money. But what you'll do is if you play the game out, if somebody actually sits down and does this on a spreadsheet and figures it out, the optimum period to hold is about 1 year, one tax cycle. Get yourself over the capital gains threshold, and then not more than 2.5 years. Depending on market conditions.
Gonna edit that out.
They will, but it's depending on the market cycle and where you're at in it, and a number of factors. But generally speaking, I did some investing with AKA that was self-storage for the last 2 years, and I was aggravated with them because they only held the assets for 2 years, but both of them had 2x.
Yeah.
You know what their projection was for a 5-year hold? 2x.
2x. Yeah, I totally get it. So what are the biggest pushbacks that we've seen from, let's just call it really rich investors, is that investing in a real estate fund is, especially if it's not thoughtfully constructed, is that I don't get a pass-through on all the goodies. The depreciation, the cost seg. Yes, if I get distributions, they're ordinary income, but beyond that, I can't 1035 the money because I'm not the GP, and so therefore I have to treat it as if I'm an LP. And so could we talk a little bit about how this is different? And if it's not, it's not. I'm just wondering.
So 1031s are not going to be done in this
That makes sense,
because
yeah.
you can't. You used to be able to do it in a private syndication where we do what we called a drop and swap. So in the previous year to the year you're anticipating selling, you would drop everybody to a TIC ownership, tenant common ownership. That would give everybody the direct ownership in the real estate. And then the following year, pretty dicey stuff.
Yeah.
Pretty dicey
It's just a little form over substance, right?
Yeah, and I always wondered how long it was going to take the IRS for them to drop the other shoe on that.
Yeah.
I didn't see it really get challenged much, but there is a form that, and I don't know the code right now, and that's what I'm saying. You really want to go and look on at the offering documents, but there is a code that allows, for example, when company that I sold, when they went from all of these private SPE ownerships of all these different assets, and they rolled it into a REIT, they did that all tax deferred.
REIT.
The UPREIT, yeah. They did it all tax deferred, and it was a 7 something in the code that allowed that to happen. And I apologize, I'm not an accountant. This is not my gig.
Yeah.
But when we talked to them about that, they said that could be applicable in this, depending again on the investor and how they want to do their reporting.
Yeah.
So, but the tax advantage is K1s are going to come. They're going to say,
Yeah.
we had this much depreciation loss, we had this much revenue,
Yeah.
and those will be consolidated into K1 for the. Well, we'll just pass them through, but the K1 you'll get a general 1065 reporting for the whole fund, and then all of those things will pass through. The only question I have is can you defer the tax on a disposition?
It's really not that important where I was headed. This is my editorial, right? As being not important. But where I was headed is if you've basically eliminated the long-term hold, you've produced a rate of return that you can control the holding and harvest the best years, and you're producing that type of return, and you have liquidity, all that other stuff kind of goes away.
At that point, I'm going to do what my dad said.
Yeah.
Give me the money, I'll pay the tax.
Yeah, exactly. That's where I was headed.
Yeah.
It doesn't even really matter.
Yeah.
Right.
At that point, it doesn't matter.
Yeah.
Changing the subject just a little bit, one of the things I think you can kind of see with this art is it is going to potentially change the industry. We believe it will. There's a lot of sponsors right now in this industry. Neil was saying, too many?
Yeah, too many. But there's a little culling of the herd going on right now. So
But we feel like what this is going to do, because of the approved sponsors, it's going to set a standard for sponsors out there that is going to be very attractive for the investors. It's going to provide liquidity. It's going to reduce the risk of investing in these kind of things. This is going to change the industry.
I think it has the potential to do
Yeah.
that. And branding, awareness, you have a lot of investors already. So I don't think we can have a conversation today without talking about ChatGPT and the AI. You mentioned it. How, if at all, has the I want to call it artificial intelligence, but automation catalyzed by, ChatGPT or some other thing being able to write your algos for you without being a developer, programmer, has that compressed the amount of time and expense for you to be able to build the platform?
we're not using it for that, although I think that so we do some third-party development work, and I think they're moving towards that where they'll write their code. We'll just say this is the outcome we want. And from talking to CCR or CTO, said that's where it's going. And I said, like, do you worry about your job? And she goes, no, because I'm the one that would interface with the developers, which would be AI. And it's like, I, like everybody else, I've got on ChatGPT and, asked standard questions like, is there a God or, whatever. But
I
beyond
can help you with that.
well, somebody actually apparently put that question in there and then answered back, not quite yet.
Right.
Somebody had to put that in there as a lark. I don't know, but for us, what it's going to be able to do is we can set parameters for our underwriting, and we can flex that. And eventually the algorithms, they tell me from the neural nets will learn how to flex within market conditions, and they will help us set our underwriting standards and then stay within those operating standards.
Yeah.
Too many times I've been in a situation, and you probably have too, say, yeah, that doesn't really quite fit the criteria, but I like you.
Yeah.
And it takes that out.
The sniff test.
Yeah.
Right?
Yeah.
Well, one of the things that I see is the algorithms can only do so much. And the beautiful part about what we're doing is we're working with all these sponsors because every market is local and every property is specific. And so you look at all of these iBuyers that have tried to use technology to buy properties and then they're losing money on, thousands and thousands of units. And so we have the opportunity to have the local operators doing the transactions and we're buying in and diversifying ourselves, but we can use those algorithms to still help us in our due diligence process. And we're also seeing that we're using it a lot on the marketing side now as well and producing this content to get the word out there about what we're doing, to get the word out there about these sponsors. There's ways that we can now systemize that where we can push that content more quickly.
Yeah. In which we are, but Arthur, we're in the relationship business here. I was just talking to one of our approved sponsors that we interviewed in the studio earlier today, and he's like, how do I find more accredited investors? Accredited investors aren't on Google searching what syndication can I invest in or what fund. That's not the way the game is played. And so that's one of the beautiful things that we're doing is we understand the importance of relationships. And we're pursuing those. We're pursuing those on social media, on LinkedIn, on different platforms, and building those relationships one-on-one because we understand the importance of it and we value the importance of it.
I think the real estate business is more subject to a relationship advantage, let's just call it that, simply because it's a hard asset. You've got to see who's managing the building. You've got to know what the neighborhood looks like. I think it really is sort of all part of that, touch, feel, hard asset type thing.
It's the ultimate tangible asset. It truly is. I hear people say, well, precious metals is tangible. And it's like, it certainly is. And I'm sure it was all tangible at one time in Fort Knox, but not there anymore. But I have yet to see anybody misplace a piece of real estate.
And it is a great asset class
It is.
for a whole bunch of reasons. And I will tell you, of the 5,000 plus family offices that are members, and I don't have 5,000 best friends, I have two, right? But without, being held to the statistics, what do they say? 90% of the statistics are made up. Well, I'm gonna make one up.
We use that
Yeah,
internally
right.
too.
Is 75% of the wealth, and one way or another, has been made with real estate. I
True.
mean, it might be somebody that sold a tech company or something like that, but what do? They turn around and invest in real estate. It actually could save what's about to happen. I mean, I'm not prognosticating because I'm not in a position to do that, but it's getting pretty ugly out there, right?
It would have lessened the blow, for sure.
Yeah.
And for the
Yeah.
sponsors who participate in this, it can help them through it
Yeah.
a great deal. So yes.
Okay, Ken, so we're going to talk about now, we've established what the program looks like. How are you going to deploy the capital?
In order to make this work, we've got to have a lot of deal flow coming our way. We've talked a little bit about how we're going to generate that. Looking through the deal flow, then we have a lot of choices we can make. We want to take the best deals that work for the fund, but we want to build that on a base of secure investments as well. So with our relationships that we have with the sponsors, we're going to be investing quite a bit going into pretty stable investments when you would have senior equity, which puts you high in the capital stack. That's going to give you your risk reduction that we're going to have in the fund. That's going to be the stable returns that the fund is going to be built on. Then we want to put on top of that the opportunistic features of the fund, where we look through the deal flow that we have, then we add on top of that some really good upside that comes from that. And then the short cycle investing that takes place, that also is going to give us the liquidity element that we need in the fund. So that's how we're going to allocate the funds, is through using those three different ways.
So stable value, mezzanine, could we call it that? Right?
Yeah, I think it's a pretty fair term. Yeah. Yeah. So when you say mezzanine, a lot of people equate that to a debt instrument,
Yeah.
but it can function very well as a matter of fact. A lot of our sponsors use the word mezzanine when we tell them about pref equity. They say, well, can we use that as mezzanine? And the answer is yeah.
In terms of cash flow, it looks the same.
Yeah.
Yeah, totally makes sense.
The only difference is we get to participate not only in a cash flow stream, but we get the appreciation too.
So if I could use an analogy, a little equity with a warrant. Right?
Exactly.
Yeah.
Yep.
Yeah.
Yeah.
How hard do you think it's going to be to do this?
Well, we're looking forward to proving how it works. We've been working on this now for well over a year to put together all the infrastructure in place. We developed the relationships with sponsors and investors to have that deal flow come through, and so we believe it's there. It's going to take place. We've had tremendous interest from everybody we've talked to, and they're all saying it's about time that takes place.
It seems so. Yeah.
I'd like to answer that question. A lot more difficult than I thought. And I'll tell you why. Because I've been the one that talked to all the investors. Again, because I want this information, because I have to deal with how we're going to change the original model, our original thinking. Talk to the investors. And I talked to a lot of these sponsors, almost all of them. Chris just talked to a number of them, and we've talked to them together. Always you get on a call with one of them and they go, could you do, and then
Then they tell
oh, okay.
yeah. Yeah, right.
Yep.
Yeah.
And then it's like, well, what about,
Yeah.
oh yeah, okay,
Okay,
yep,
yeah,
yep. So it's, I would say the complications have grown, not quite exponentially, but there's been but it's okay because it's giving us a better grasp of what this needs to be and how because your customer voice is the most critical thing you could ever listen to.
Yeah.
You know, you've got to
sure.
you got to listen to them all the way through. And so we originally thought, I think that's one of the reasons it's taken us so long is because we're getting so much valuable input from the industry right now. And we've already started. We've already started doing these sponsor interviews. We've already started interviewing investors, and they continually give us good ideas. And they're starting to solidify around some core concepts, you know, and fortunately they fit within the models that we built for this. It's just, how is it going to be received and how is it going to be utilized by the investing community?
And I think that the thing to emphasize with that is every single challenge that they've brought up for us has created a new opportunity.
New opportunity,
And so now
absolutely.
it just provides more need for those funds.
Yeah. And a couple of those challenges that I can think of that have kind of made this a little bit bigger for us is when we're presented with a challenge, well, who do we need to hire internally to help us meet what the market wants, right? Not only that, is hiring outside legal counsel to guide us in different directions, whether it's things on the marketing side, whether it's things for the PPM and the fund, right? Like we have an internal attorney that's one of our partners. Additionally, we've hired multiple outside firms to be able to guide us to make sure that we're following regulations.
Yeah. It's people complain about attorneys, but boy, they've made my life better
Well,
Yeah.
in
definitely,
so many ways.
most
Yeah.
definitely, and
They can also do the opposite too.
Oh, for sure. Yeah.
but the fact that we've had Brad as one of our partners has just been so amazing, just great guidance all the way through.
And he's very conservative.
Yeah, very, very conservative. So great people, but what you just said, you look at it and you say, can you guys contain the cash burn for the next 6 months? Their answer is, we'll increase it by 30%. But how do you not do that and not embrace what the market's telling you? And you can yell and scream about it and you do whatever you want to do as a startup, but you say, if you stop listening, you're dead before you get out of the gates.
Yeah, the marketplace will dictate what's important.
They will.
Yeah, how many times have we seen businesses come up with an idea that they thought wasn't a good idea, and then it fell flat because they didn't do the work, right?
It's not lack of ideas, it's lack of execution.
Yeah, execution and executing the wrong thing.
Executing on the wrong
Yeah,
thing.
yeah.
Yeah. And so that kind of expense is not expensive. It's
Investment.
that kind of investment is not expensive because you're investing in what the market wants.
Yeah,
What's expensive is making an investment in something no one wants.
that's exactly.
That's really expensive.
Yeah.
You indicated that the market is going to dictate whatever that is. And it's interesting to me when you look across our careers that we've had in doing this business, that nobody's done this yet is amazing to me. Because it's a huge opportunity that is not there. That it's just simply not there. Nobody has gone out and tried to marry the interests of both investors and the sponsors yet. And this is going to be an opportunity, I think, for those who do get involved in this. It's going to change the way they do business. It's going to give them an awful lot more investors.
That's the saddest thing as a sponsor, being one for 42 years. Your interest as a sponsor is not aligned 100% with your interest of the investors, the people you put in that.
Yeah.
And it is an ugly thing about real estate syndication.
Don't feel like the Lone Ranger though. The venture capital business, flush 90% of the companies, pile cash onto the unicorns,
Yeah.
right?
But that's their issue.
Yeah.
Mine has been this, in my little compartmentalized world, I've always hated the fact that I cannot fully align my interests.
Yeah.
What Pre-iShare is going about to do for the industry is take a lot of those issues off the table. Yeah. And that's what I think is cool about it.
And I think that what I'm hearing is the startup technology business, for example. It used to take $500,000 to hire developers and build an app. Now you can do it in 2 days.
Yeah.
The technology has enabled a lot of people to start things that were virtually impossible or unfinanceable because of the advances in technology. And I know people talk about this all the time, but I see it in action all the time. You know, you can build a tech stack for a fraction of what you would have otherwise been able to do it years ago.
You know?
Clearly, this is a 506c. You've got to be an accredited investor in order, at the very minimum, in order to invest in this. And this is not an offering. And so if anybody wants more information, they've got to look at the official offering documentation. They have to go through the process, and we need to make sure that they qualify.
Yeah, and as usual, this is, education, information for the family office community and should be treated as such. This has been super fun. So much glad that we were able to get to know each other. I don't know you guys yet. He's all right. And
I need to borrow that $10 from you then.
yeah, okay. And so I guess it should be the other way around. Like, I'm giving you $10, you should say something nice about me, right? But
Yeah, that's true. That's absolutely
I'll
true.
take $10 from both of you.
Okay, that's right. So really, really interesting. I don't need to editorialize things, but I often do. And in this case, I think there is a high probability that not only this will be a success, but change the industry for the better. And I think you guys will do great with it. And so I'm so glad you chose to share it with the Family Office Insights community and have me down here and do this with you. Super appreciate it.
Well, thank you.
Thanks, Arthur.
Yeah.
This investment is for accredited investors only. This is a 506c offering. Please read pre-iShares memorandums and LLC agreements. These will define your rights as a member of the limited liability company. You must read these documents before making an investment in the pre-iShare liquidity fund. Make sure to follow pre-iShare on all of our social channels and tune into the show. Become a part of the conversation. Go to preiShare.com to learn more.